For Wall Street Media, I'm Mike, I'm here with Doug, and we'll help you make money in the stock market with information you can't find anywhere else.
Hey, good morning, my friend.
Good morning.
Hey, guys, we've got Rich Gordon from Wachovia. He is the most respected guy in this field talking about bonds and the outlook for corporate bonds, treasury bonds, yields, spreads. Really good stuff today.
Okay, well, he's the fixed income market strategist of Wachovia, ticker WFC. And he discusses the emerging economic themes for 2009 and warns investors to position portfolios accordingly as each theme evolves throughout the year. The main themes are the extremely weak economy and deepening recession, and the expansion of fiscal stimulus and government involvement in the financial industry. That sounds pretty bad, actually, doesn't it?
These are pretty dark times. I was telling you this morning, I walked in again today, and stores are just closing at record rates, and like prices that I've seen for things that I know were a couple $1,000s, like these fancy Sleep Number mattresses. I saw this morning they had a sign in the store that they had them queen size for $500. I know that's not what they've been selling them for, right?
Maybe that's not what they made them for either, right?
Yeah, I know. You and I were talking about that perhaps they're just trying to keep cash flow going so that they can stay open in business. And I think, we're in kind of a horrible spiral right now where everybody's worried they're losing jobs. Rich in the video says, could be another 570,000 this Friday when they release job numbers, right? We saw Macy's, we're in New York, and we saw Macy's laid off 7,000 more people this Monday, right? And I think when everybody's so afraid of that, it starts like this terrible spiral where you hold on to your money, then the store lays off somebody else, and pretty soon they're laying you off.
No, the people that get laid off, they hardly get any new jobs right now.
Right, and they're not spending money, and so the remaining stores, don't spend money, right? And consumer spending's 2/3 of our economy.
Right.
Yeah.
Let's see what Rich Gordon has to say. Here's the clip.
Hi, and welcome again to Market Summary Online. The first month of 2009 is over now, and we've seen a few themes emerging. Investors should be well aware of what these themes are and position portfolios accordingly as each one evolves throughout the year. The first theme is an extremely weak economy and deepening recession. Last week's economic data presented a grim view of U.S. economic conditions. GDP came in at negative 3.8%, the worst performance for economic growth since 1982. It would have been worse, except that inventories rose sharply. Other than inventories, only the government portion of GDP grew at a positive rate. Durable goods dropped by 22.4%, and non-durables fell by 7.1%. Both the major importing and exporting nations in the world are experiencing sharp contractions from their previous levels of economic production. The dollar has risen almost 6% so far this year, and we expect that it will continue to trade well as European central banks, especially the BOE, move towards ultra-low interest rate policies to ward off an even deeper recession. Several other economic data points further highlight the severity of this economic contraction. Initial jobless claims reached the highest level since the deep recession of 1982, as U.S. companies have started to aggressively cut their workforces. The non-farm payrolls report has shown job losses for the past 12 months, and Wachovia's economics group expects a further contraction of 575,000 jobs in Friday's report. Consumer confidence reached its lowest level since the mid-1960s. The extreme weakness of this data reflects the large number of people that are either worried about losing the job they have or are making significantly less money now than they once were as a result of this economic contraction. The second theme for 2009 is the expansion of fiscal stimulus and government involvement in the financial industry. The new administration in Washington is working towards jump-starting the economy with a number of initiatives, including the following. One is a broad fiscal stimulus package in excess of $800 billion. In its size and scope, it's like Roosevelt's New Deal during the Great Depression, and while there may be disagreements with certain aspects of it, there's little doubt that given the continued deterioration in the economic data, a package of this magnitude is really needed right now. The new administration is also tying federal capital support for banks and financials from the TARP program to affirmative lending requirements, after lawmakers directed criticism at the banking industry that the first portion of the funds haven't been lent out yet. President Obama has said that if they get federal funds, they're going to be required to lend it out. Banks don't want to ease their lending requirements because they just don't know how much in losses on commercial and consumer loans they'll ultimately have to take. So they continue to aggressively build up their reserves. There is a growing school of thought that if taxpayers are footing the bill and effectively absorbing the downside risks in these loans, then the government should own the banks, at least until they can be spun back into private hands. It's a complex issue, but it's really hard to see how or why we'd be better off nationalizing rather than recapitalizing the banking system. This is because bank balance sheets are leveraged at approximately 12 to 1, so banks can loan out $12 for every dollar of real capital that they have. If the government stepped in, they'd have to issue debt to support each dollar of loans that they make. The other obvious flaw to the theory that the bank should be nationalized is that once that happens, the exit strategy becomes very difficult to implement. Equity investors that saw the value of their bank shares severely diminished by federal capital infusions would be very reluctant to invest in banks once they're spun off, because a dangerous precedent for widespread nationalization of private assets would have been set. The third theme I want to talk about is higher long government bond yields in 2009 and a steeper curve. Up until Monday's correction, long-term Treasury yields had risen steadily since mid-January. The chart shows the 10-year Treasury went from being extremely overbought at the end of 2008 to being oversold at the end of last week. We think that the general trends that have been established in January, higher Treasury yields, tighter corporate spreads, and equity markets unable to gain upward traction will be pervasive for a lot of 2009. The trade-off in treasuries during January was severe, and you'd expect the momentum to slow, followed by some price consolidation for a period of time. But government yields are still at historically low levels, and the government's policy of quantitative easing means that there will be a very heavy issuance calendar in treasuries for the next several years. So we think that portfolios are still best positioned short of duration targets, selling into any counter-trend rallies like Monday's. Two-year Treasury yields, while slightly higher on the year, are anchored by the Fed's near-zero interest rate policy. Eventually, those yields will rise, pushed higher by the same heavy supply backdrop that's weighing on the long end, but the front end probably won't trade off significantly as long as Fed policy remains very accommodative. Given the recent economic reports, count on short rates holding a fairly tight range, at least for the first half of 2009. Fourth, weak fundamentals and strong technicals should mean stable corporate spreads. Investment-grade corporates have been the greatest beneficiary of sector rotation inflows over the past 2 months. Yields had reached over 8% in October, a month which saw some of the largest risk aversion moves in the financial markets history. Investment-grade spreads have tightened by over 100 basis points from their wides, about a 20% retracement of the spread widening, despite the poor economic conditions and fundamentals. The upgrade-downgrade ratio so far in 2009 shows 10 downgrades for every upgrade, and the corporate speculative grade default rate continued to move higher last month. Many analysts now believe that the more pessimistic default assumptions are more likely than Moody's base case forecast. The technical picture has been very positive for spreads, and it's helped drive spreads tighter each week for the past 7. First, crossover investors have moved into the sector, lured by a combination of high yields and better liquidity than competing alternatives in structured products. Insurance companies, pension funds, and even retail investors saw yields in excess of 7% and even 8% on blue-chip names. Also, traditional equity investors that were weary of the continued high levels of volatility and inability of the market to sustain rallies have moved to corporates because it's a coupon-paying, lower volatility alternative. Second, and probably due in large part to this broad-based sponsorship by crossover buyers, the new issuance calendar has been both active and well-received. January issuance was in excess of $120 billion. Approximately 60% of this amount was FDIC-guaranteed paper financials, which have attracted traditional sovereign and quasi-sovereign credit buyers rather than corporate credit investors. The competition for traditional corporate paper has kept tightening pressure on spreads, and we would expect to see this continue over the next few weeks. Thanks for joining us, and we'll see you next week at Market Summary Online.
And we're back.
Hey, Rich Gordon is the best in the business at this. You guys, you should go get a tablet, etch this stuff into a tablet that he's saying, and use it as your commandments for the year. Thanks, German.
Yeah, thank you. We're here every day at Wall Street Media. You can find us directly at wsmco.com. Thanks.